What if I told you there's a penny stock trading under $2 that just demonstrated a 95% reduction in cognitive decline in Alzheimer's patients? I am talking about actual phase 2 clinical trial results with institutional investors backing up the truck and analysts rating it a strong buy. Today, we're diving into a biotech that could be sitting on one of the biggest Alzheimer's breakthroughs in decades, and later I'll reveal a second pick that's the complete opposite, a profitable company delivering results for 15 straight quarters. Let's get into it. Cognition Therapeutics, ticker CGTX, is currently around $1.69 with a market cap of $149 million. 3 Wall Street analysts rate this a strong buy with an average price target of $2.88, representing 67% upside. So what makes this different from every other biotech penny stock? CGTX is developing zervimsine, also known as CT1812, a drug that penetrates the blood-brain barrier and targets the S2R complex involved in Alzheimer's progression. The phase 2 SHINE study showed zervimsine slowed cognitive deterioration by 95% in patients with lower p-tau to 1.7 levels. That's not a typo, 95%. Most approved Alzheimer's drugs show 20 to 30% benefits. This is game-changing if it replicates in larger trials. Their phase 2 START study has hit 75% to enrollment of 540 participants with mild cognitive impairment and early Alzheimer's. Here's the crucial part. It's funded by the National Institute of Aging, meaning the government is covering trial costs, significantly reducing cash burn. This 18-month study evaluates the drug against placebo, and positive results could make this a blockbuster drug generating billions annually. What separates CGTX from other biotech penny stocks is FDA alignment on their registrational path for phase 3. When the FDA gives this alignment, they're essentially saying, if you run the trial correctly and hit your endpoints, we'll seriously consider approval. This dramatically de-risks the regulatory pathway. They've also scheduled meetings with the European Medicines Agency for February 2026, opening up the massive European market. The company completed enrollment in their expanded access program for dementia with Lewy bodies. This program was enabled by a donation from a family whose member participated in their phase 2 trial and was so impressed they funded broader access. That tells you something about real-world effectiveness. Now the financials. Third quarter 2025 showed a net loss of $9.9 million, up from $6.7 million in Q3 2023. Losses are increasing as they ramp up trials, which is expected. Research and development expenses, or $11.4 million, actually down slightly from $11.7 million previously, showing disciplined spending. Here's the critical part. Cash runway. As of September 30th, they had $22 million in cash plus $53.6 million in National Institute of Aging grant funds available. That's $75 million total, providing runway into Q2 2027. But it gets better. In August 2025, they closed a $30 million offering at $2.05 per share to 2 new institutional investors. These aren't retail gamblers, these are sophisticated institutions who conducted months of due diligence and wrote multi-million-dollar checks at $2.05. The stock now trades below that level, meaning retail can buy cheaper than institutions paid. Total cash position is approximately $76 million. Extending runway potentially into early 2028. The institutional validation is massive. These funds invest with 3 to 5 year horizons and expect significant returns. Their willingness to pay $2.05 tells you what smart money believes this is worth. Analyst coverage shows 3 analysts with strong buy consensus and $2.83 average price target. Targets range from $1.50 to $4. That $4 high end represents 142% upside. H.C. Wainwright reiterated by December, and B. Riley raised their target to $3 in November, citing promising dementia treatment advances. CGTX isn't putting all eggs in one basket. They're developing CT1812 for geographic atrophy secondary to dry age-related macular degeneration and dementia with Lewy bodies. This multi-indication approach de-risks the investment. Even if Alzheimer's hits a snag, they have other shots on goal. Dementia with Lewy bodies affects over 1 million Americans with virtually no effective treatments available. Key catalysts over the next 12 to 18 months. Phase 2 START study. completion, and readout, which if it replicates the 95% result will gap the stock up significantly. Tight CFDA meeting in late January 2026 for their Phase 3 dementia with Lewy bodies program. February 2026 AMA meeting potentially doubling their addressable market to 450 million Europeans. Phase 3 trial initiation in Alzheimer's in first half 2026, a major de-risking event. De-risks, clinical trial failure is the biggest. If START doesn't replicate SHINE results, this stock gets hammered. Biotech is binary. Trials work or they don't, and failures can lose 50 to 70% value quickly. Second risk is dilution if trials take longer than expected. Third is competition from other Alzheimer's drug developers, but the risk-reward is compelling. Stock at 165, institutions paid 205, analysts average 288. That's 75% upside to analyst average and 142% to the high target. Downside is probably 80 cents to $1 if trials fail. So 50% downside versus 100+% upside with FDA alignment and institutional validation. Portfolio-wise, CGTX should be 1 to 3% of your portfolio. This isn't a 20% position. If you have $10,000, bets to $300 in CGTX. If it zeros, it won't devastate you. If it triples, it meaningfully impacts returns. Now let me show you the complete opposite. If CGTX is aggressive growth for volatility-tolerant investors, this next tick is steady profitability. Waterdrop Pink, ticker WDH, trades around $1.79 with a $652 million market cap. This isn't clinical stage burning cash. This is profitable, revenue generating, crushing it for 15 consecutive quarters while trading under $2. Waterdrop provides online insurance brokerage in China. 3 segments: insurance marketplace as core business, medical crowdfunding for user acquisition, and e-fine for clinical trial patient recruitment. Multiple revenue streams reduce single segment risk. Q3 2025. Total revenue hit CNY 975 million, up 38.4% year-over-year. Net profit surged 60.1% to CNY 158 million. That's actual profit growing over 60%. 15 consecutive profitable quarter. Finding a profitable penny stock for 15 straight quarters growing revenue at 40% is incredibly rare. Operating expenses fell to 39.6% of revenue, down 8.3 percentage points, showing scale efficiencies. Operating profit hit RMB 113.8 million, up 329.8% year-over-year. They quadrupled operating profit while growing revenue 40%. First 9 months, revenue CNY 2.57 billion, up 23.1%. Net profit CNY 410 million, up 51.9%. Insurance revenue grew to RMB 869.7 million, up 44.8%, with operating profit RMB 176.4 million, up 40%. Core insurance business growing at 45% with strong profitability. Waterdrop's all-in AI strategy achieved 120% net profit increase in 2024. AI reduced manual review costs by 50% and increased patient enrollment efficiency by 45%. They have over 100 AI patents and invested RMB 217 million in R&D. Their AI solution Waterdrop Guardian is a large language model for insurance and healthcare driving real results. AI medical insurance expert facilitated an 82% increase in premiums, meaning AI isn't just cutting costs, it's driving top-line revenue. Clinical trials business expanded to 216 organizations, enrolled 1,066 patients, resulting in 31.3% revenue increase. Medical crowdfunding platform. 485 million people donated RMB 71.2 billion to 3.61 million patients. 485 million users creates enormous network effects for cross-selling insurance and healthcare services. Shareholder value. By November, they repurchased 58.1 million shares totaling $113 million. Management buying back stock signals undervaluation. They completed their 4th dividend distribution since IPO. $10.9 million payout. A penny stock under $2 profitable enough to buy back stock and pay dividends is almost unheard of. Cash position, RMB 3,510 million, equivalent to $493 million. $500 million in cash with no debt provides flexibility for acquisitions, development, or more shareholder returns. Analyst coverage shows median price target of $1.79. While targets are conservative, fundamentals tell a compelling story. Goldman Sachs, UOB Kay Hian, and Guotai Junan maintain buy ratings citing operational leverage and margin expansion. Chinese regulatory risk is real, probably why the stock trades at low multiples despite strong fundamentals. However, Waterdrop has operated successfully for years, maintains a level ESG rating, and collaborates with government entities. They established 167 rural clinics serving 500,000 beneficiaries, providing social impact and political goodwill. Catalysts. Q4 full-year results March 12, 2026. Continued AI integration driving margin expansion, insurance portfolio expansion accelerating revenue, and potential index inclusion driving institutional buying. Management confident in exceeding guidance. Bottom line. CGTX is high-risk, high-reward biotech for investors understanding binary risk, wanting Alzheimer's breakthrough exposure with FDA alignment. Binary bet that could 0 or triple plus over 18 to 24 months. WDH is Chinese tech and insurance growth through profitable execution, AI efficiency, and shareholder-friendly allocation. Steady compounder offering consistent profit growth and dividends with lower downside risk. Portfolio construction. CGTX, 1 to 3% given binary profile. $10,000 portfolio means 1 to 300 in CGTX. WDH 3 to 7% given profitability and cash flow. Same portfolio, 3 to 700 in WDH, sized larger due to lower loss probability. Both address massive markets, Alzheimer's therapeutics exceeding $13 billion by 2030. Chinese insurance serving hundreds of millions in aging population. CGTX has FDA meeting January, EMA February, Phase 3 initiations. WDH has March earnings showing continued acceleration. This isn't financial advice. Do your own due diligence based on risk tolerance and strategy. CGTX at 169 with 149 million market cap, negative earnings, 350 analyst target representing over 100% upside. High volatility with beta 1.24. Trading between 22 cents and 383 over 52 weeks. WDH at 179 with 660 million market cap. Profitable with 20 cents EPS. Pay ratio 8.95. TAS 3.35 PRCENT dividend. To 25 analyst target. Beta negative 0.24. Much more stable range 108 to 218.